afternoon. It's 4 o'clock, so we're going to go ahead and get started. We'd like to welcome you to Low Load Insurance Services' third webinar of 2011. The scrolling slides moments ago filled you in on some continuing education and other information. If you missed any of those slides, be sure to visit the new education pages of our website for more information. Today's presentation, Life Insurance 101, will last about 50 minutes with a break for questions submitted on screen after slide 17 and verbal questions at the end of the presentation. The webinar is being recorded and will be posted to our website within about a week. Today's presenter is Mark Maurer. He's a CFP and MBA, a member of the National Association of Insurance and Financial Advisors, and a popular speaker for financial organizations including the Alliance of Cambridge Advisors, NAPFA, Garrett Planning Network, LIMRA, LOMA, and Society of Actuaries. He's also a contributing insurance resource to industry publications including Businessweek, Bloomberg.com, NAPFA Advisor Magazine, AMA Physician's Guide to Financial Planning, and Jane Bryant Quinn's book, Making the Most of Your Money Now. The son of insurance experts Keith and Judith Maurer, Mark grew up in the insurance industry and has an impressive combination of education and mentoring. He's constantly monitoring the insurance and financial services industries, and under his leadership, LOIS continues to expand its portfolio of products and services. Mark's dedication, along with his unique industry perspective, education, and experience, allow him to build upon the LOIS traditions of cutting-edge information and customer service that fee-only financial advisors and their clients have relied upon since 1992. Mark, take it away.
Hi, everybody. Thank you for tuning in to our April webinar. And today, as we did our series of webinars last year, a number of advisors asked for sort of it, and we'll call it a Life Insurance 101 because that's what we're calling it. Just getting back to the basics. I think we see enough illustrations of equity indexed ULs or variable survivorship whole life policies, and while those may or may not fit any kind of need, getting back to the basics of what is permanent life insurance, what is whole life, what is term. And so that's what we're going to talk about today, and we're going to get started. Hold on with me 1 second. I'm sorry about this. Okay, sorry about that, everybody. A little technical glitch, but don't worry. The information is still the same. It's still just as exciting. And what we're going to cover, the history of life insurance. We're just going to touch on this briefly about just really how the idea of pooled risk came about and how it's progressed to where we are today. Basic, touching on the types of life insurance, term, permanent, and then the point of all this is so that when you have clients come into your office or you're looking at their financial portfolio and their risk program, what are the types of insurance, life insurance especially, that are going to best meet their needs. The whole idea of life insurance is pooling risk, and as far back as we go, farming communities would have at the end of the harvest, everyone would put aside a little bit in case something happened to one of the people in that, one of the families in that community, so that in practice, if the farmer were to die, there would be food to feed his survivors, most likely the children. So pooling that risk of if everybody puts in a little bit of the crops, there would be enough to cover, sustain a family for till the next year. And then later on, especially here in Tampa, where Tampa cigar industry was very big here, and a lot of the workers at the cigar factories had social clubs. There was an Italian club, there was a Cuban club, and they would all pay in a small portion of all of their wages to the club, and then if someone in the one of the workers at the Italian club were to die, there was money there that paid for widows and orphans so that they wouldn't eat, not actually paying in food, but paying in money to provide. Later on, groups got bigger. It wasn't as isolated as a local social club, but there were religious groups. Many of you may be familiar with Thrivent, which started as Aid Association for Lutherans. Fraternal organizations like the Knights of Columbus started off as one of their benefits to their group members was providing that risk protection, which has now grown into actual insurance companies. And then even beyond that, people who aren't a member of one of these groups are able to get life insurance through the insurance companies of today. When we talk about life insurance in particular, originally we had whole life insurance and annual renewable term. Whole life, you paid a fixed premium for your whole life, which in the early days assumed that everybody died by age 95. And then annual renewable term that had a premium, you know what it was this year, and then every year after the first year premium, it renewed, and it wasn't a guaranteed renewable, it was just whatever the rates were going to be next year. And rates were based off males, so someone who was age 55, whether you were male or female, smoker or non-smoker, all paid the same premium. Today, of course, we have level term, where you can guarantee a 30-year level premium on a term life insurance policy. Annual renewable term, very similar. Some policies may have a 5-year guaranteed increasing rate, and then after year 6, it's annual renewable. Universal life, which is a flexible premium type of life insurance, permanent life insurance, and we're going to touch on these more. Whole life insurance being a fixed premium contract. Instead of just having one rate for somebody age 55, we have super preferred plus male and non-smoker rates, male and female rates, smoker rates, rates for someone who chews tobacco as compared to smoke cigarettes. There are table ratings, table B, table D for substandard risks. There are flat extras attached to policies for someone who might be a pilot. So there are all kinds of different ways of classifying a person for what rates they're going to pay on the life insurance coverage. And we have guarantees and illustrations. The idea of a guaranteed level premium on a no-lapse guarantee universal life policy or a 30-year term policy, illustrations for something like a dividend-paying whole life policy, or even a variable type policy where there are assumptions made on how this policy is going to perform. So where's the risk in these different types of policies? When we have a policy that truly is guaranteed contractually, and except for non-payment of premium, we're going to say that a level term policy or a no-lapse guarantee universal life policy, the insurance company is essentially retaining all the risk. $1 million 30-year term policy, client's paying $550 a year, guaranteed that if he or she dies in that 30 years, the life insurance company pays out the $1 million, also guaranteeing that that $550 per year will not increase over the next 30 years. When we move to a different type of policy, a current assumption universal life policy, which is probably the most common up until a few years ago, where policy was earning